Good morning, afternoon, evening. This is a presentation on the topic of long term incentives that I took as a session on the forum LEDX Learn, Engage, and Design. I thought it would be a good idea to record the presentation and share it for future reference if you'd like to use it at a later point of time. In this presentation, the main topic that we are discussing, of course, in detail is long-term incentive, the different types of LTI instruments, the design aspects that go into the creation of a long-term incentive program. But we will, before we delve into that, do a refresher on the concept of total rewards, key reward objectives, the different reward elements that exist and why they exist, the objectives around it. We will talk about incentives in general and long-term incentives in particular as they fit in the total rewards construct. And towards the end of the session, we will cover a high-level overview of laws, regulations, and governance aspects that need to be kept in mind as we formulate a long-term incentive program in our organizations. Total rewards, a very strong concept, a very important concept because it talks about rewards that an individual gets beyond just compensation. Typically, the total rewards construct consists of compensation, the benefits, the career opportunities that an individual receives or is exposed to as part of being in an organization. The compensation elements of file very clear in terms of fixed compensation, short-term incentives, long-term incentives. Benefits too are quite commonly understood in terms of whether it is retirals, time off policies, insurance, which manage risk, perquisites that an individual receives as part of being associated with a particular organization. But sometimes the ones that are underestimated are aspects related to career, the learning the individual gets, the growth the individual receives, the recognition an individual receives as part of being in an organization or being associated with a brand. So total rewards really represents the cumulative value that the organization provides an individual in exchange for the services that the individual renders to the organization. Each reward element has a specific purpose. For example, the fixed or base compensation pays for the capability that's required to perform the role. Incentives in general incentivize the behavior that we want to see. Short-term incentives do that in the short term, which is typically referred to as 1 year or below. Long-term incentives do that in the long term, typically a year and above. And it's very important to understand what motivates an individual and as a result, which reward element needs to be emphasized in a total rewards construct as it pertains to that individual. Diving a bit more detail into long-term incentives, when we talk about LTI, the most common terms or words that come to people's mind are, of course, ESOPs, RSUs, stock. But it's important to understand that there are a variety of long-term incentive instruments. And again, each of them serve different purposes. In this particular slide, I am looking at LTI instrument classification in three different manner. One, based on the value that the instrument provides. Second, the type of settlement that is done on the long-term incentive award. And the third, the primary objective that the long-term incentive drives. In terms of value, a long-term incentive instrument could be an appreciation-based instrument, meaning it provides a value to an individual if there is an increase or appreciation in the value of the underlying asset. A full value instrument, on the other hand, provides value to an individual irrespective of any appreciation in the underlying asset. We will delve a bit more detail into this concept in a couple of slides, but it's important to understand that primary differentiation between appreciation based and full value instrument. In terms of settlement, settlement essentially refers to how the award is given whenever it is earned. You could have cash settled long-term incentive awards, which means the award is given to the individual in the form of a cash component, or it could be equity or stock settled LTI award. Again, in terms of the objective that the LTI instrument serves to achieve, it could either be primarily on retention, or it could be primarily on performance, or it could be a combination of both. Appreciation-based instruments, ESOPs is a typical example because ESOPs deliver value when there is an actual growth in the share price between the date of grant to the date of earning or vest. Another similar appreciation-based instrument is a stock appreciation right, or SARS. Full value instruments could be shares or stock units that deliver some value from the date of grant itself. Cash settled LTI awards, deferred bonuses are quite common in many organizations. You could have a stock appreciation right which is settled in the form of cash, which means the gain at the end of the vesting period or the earning period is settled in the form of cash. Or you could have phantom stock. All of these are typically cash settled LTI awards. Equity settled options could be stock options, shares, in which the value at the end of the vesting period is delivered in the form of some kind of a stock award. If retention is the primary objective, RSUs or restricted stock units are the most common LTI instrument. If performance is the primary objective, shareholders typically like to see performance-linked share units or a variant of that. As we get into the next couple of slides, we will talk a bit more detail about two main instruments, ESOP and RSU, and then use those fundamentals to discuss the design elements that go into an LTI program. Let's begin with stock options. Now, what is a stock option? As the term suggests, it is an option or a choice. It's an option or a choice provided to a beneficiary to purchase a predetermined number of stock in the future at a predetermined price. Now, there are important keywords here. One, it's a choice. It is provided to a specific beneficiary. It is regarding a predetermined number of stock which are available at a future date, but at a predetermined price. A beneficiary is the awardee. The predetermined number of options is what is referred to as a grant size or allotment size. The future date is what is governed by the vesting period that the stock option program has. And the predetermined price is what is referred to as the grant price or the strike price. Now, how does a stock option really work? Take an illustration of an organization which has its share price moving steadily upwards. So it's a growth scenario. Assume the share price originally was $10 and went on to 12, 16, 30 over the period of the next 5 to 10 years. Now, how a stock option would work is at the grant date, there would be a price that is set for the option, which is referred to as the grant or the strike price. Now, in this example, the price or strike price is set at the same price as the share price in the market on that particular date. It is possible to provide the stock option at a different strike price from what it is in the open market. But from a good governance perspective, typically the strike price or the grant price is set at the fair value of the underlying asset or the stock on the date of the grant. So grant price at $10. By the vesting time, the individual in these examples has seen some gain, but the person has not realized that gain yet because he or she has not chosen to exercise the option. Exercise date is the date in which the employee chooses to exercise the option, meaning the individual chooses to pay the $10, which was set as the grant price, to buy that stock option and convert it into a share. Now, what's happening here is on that exercise date, the individual has paid $10 and is receiving a share which is worth $16. And that's where the gain on exercise comes in. The individual could choose to exercise at this point and retain that asset as a share for the future and sell it later at a value of $30 in this example. Then this delta between the $30 at which the share was sold and the $16 at which was the price at which the share was acquired is considered capital gain. So there are two different kinds of gain that have happened. One, the gain on exercise, which is paying $10 to get an asset worth $16, and then later the capital gain between $30 and $16 in this particular example. While tax rules do vary from country to country and jurisdiction to the other, in most tax jurisdictions, the gain on exercise is treated as equivalent to income, ordinary income, and taxed as a result on income tax rates. Whereas capital gains do have a different tax rate, which is a capital gain tax rate, and typically it's lower than income tax rates. Of course, anything with stock, there is always a bit of uncertainty, and it is possible that instead of the share price going up, it actually goes down in the future. And if it does, a stock option essentially holds no value. Take an example, if at the time of vesting or the time of exercise, if the price of the share was now $9, then there is no value to the individual because he or she will have to pay $10 to acquire an asset worth $9, which does not really make a lot of sense. Those scenarios are referred to as underwater options, and as a result, the option does not hold any value for the individual. Now we will look at a similar scenario, but a different LTI instrument called the RSU, or a restricted stock unit. It's also referred to as a full value instrument. Same example, a share moving up from $10 to $12 to $16 to $30. The key difference being that in an RSU, the strike price is set at almost zero. And I use the term almost zero because in some countries, there is a minimum value that needs to be set as a strike or a grant price. but it's quite negligible. It's close to zero. So essentially, here the individual is receiving a grant at a price which is $0 almost. So there is an inherent value right at the time of the grant. And then, of course, on vesting, the individual has gained the entire value of the underlying asset as a gain. With RSUs, there is technically no exercise required because there is no payment to be done. So we refer to the vesting date also being the date at which shares are delivered. In some organizations, it's referred to as a settlement date. And that settlement date triggers any income tax from a perspective of the gain on vesting. Because on this date, $12 worth of asset has been delivered to the individual at a negligible or a zero price. Of course, any capital gains then will be calculated from that rate to the future, and capital gains in this example would be taxed from 30 versus 12 as and when the individual sells the share in the future. This is one of the reasons why the RSU can also be described as a deep discount stock option, because if you see this example again, on the grant date, an asset which is a fair value of $10 has actually been granted at almost a zero price, which is a deep discount. So an RSU is a deep discount stock option because pretty much the rest of the process works exactly like a stock option does. Some basic terminologies as we get into the details of design parameters and the different trade-off points. There is an aspect of dilution that needs to be considered with stock awards. Dilution refers to the dilution of ownership that a shareholder is experiencing as we give away a bit of equity to fund our long-term incentive program. As a result, dilution becomes an important consideration, and shareholders are very sensitive to the aspect of dilution. So this becomes an important design element that needs to be kept in mind as we formulate a long-term incentive program. Then there is the aspect of cost. Long-term incentives are part of compensation. There are accounting rules around how to cost that compensation based on fair value rules. And as a result, the management team needs to be aware of the cost that is taken into the books through the creation of a long-term incentive program. In terms of value that is delivered to an individual, it could be perceived in different ways. One could be fair value. Fair value is what is today's value of that particular award. Then there is the term potential value. What is the potential value of that award in the future? And the third could be an element of market value, the value at which the asset is traded actively in the market. And all these aspects of value do have a different dimension as we look at the impact of this on the long-term incentive design. We'll begin with a consideration of value, looking at from a lens of the beneficiary. Let's compare fair value versus potential value, and here defined here as fair value being the value of the grant today, and potential value being the expected value of that grant in the future. Let's take an example of a delivery of $100,000 worth of compensation through an LTI award program, and assume the share price goes up from $10 to 20, or is expected to go up from $10 to 20. Now, $100,000 can be distributed in two different ways. One is it could be based on today's value, which is $10, or it could be 100,000 delivered based on the potential future value, which is $20. If it is done based on $10, you would need to give away 10,000 stock. I mean, assuming this is a full value instrument. So the number of shares required to deliver $100,000 at the current share price of $10 using a current or a fair value approach is 100,000 divided by 10,000 shares. But if you were to look at the future potential and say, I want to deliver 100,000 at a future potential of $20 per share, then you need 100,000 divided by 20, 5,000 shares. So there is a difference in the number of shares that are required to achieve that target compensation level, depending on whether you look at current value or the potential future value. So assuming a growth scenario for a similar value delivered, the potential value approach is definitely less dilutive than the current value approach. Design consideration from a risk and retention perspective, you could have appreciation based instruments like we mentioned earlier, or full value instruments. Appreciation based instruments growing only if there is a growth in the underlying asset. Otherwise, the current value is always intangible. A full value instrument has some tangible current value always, and it would exist even if the underlying asset were to have a negative growth or a depreciation. We will go back to an example that we had taken in the past about a $10 share which goes down to $9 in the future. Now, if the LTI award had been given in the form of an appreciation linked instrument, there is no value for the individual because now the value of the asset is less than the grant or the strike price at which the beneficiary is permitted to acquire that value. So it is an underwater asset and no value to the beneficiary. But if it was a full value instrument, an RSU or a share, then even though the price went down from $10 to $9, there is still $9 worth of value left in the asset for the individual. So from a beneficiary perspective, the full value instruments are as a result less risk and hence more retentive than appreciation based instruments. Now, if we were to look at from a perspective of dilution, this is an example that we did talk about earlier as well. If we use an appreciation based instrument versus a full value instrument, in order to deliver a gain of $100,000 in the future 5 years in this example, more number of shares or a higher dilution is required in an appreciation based instrument versus in a full value instrument. Because here the $100,000 is divided by the gain in the share price, 10 to 20. So 100,000 divided by 10, becoming a 10,000 shares. Whereas in the full value instrument, 100,000 is divided by the 20 because the strike price was 0. And as a result, 20 minus 0 is the gain that the individual got. And 100,000 divided by 20 is 5,000 shares. So for a similar target value, an appreciation linked instrument like ESOP would definitely be more dilutive than a full value instrument like an RSU. Of course, there are trade-offs, and the trade-off typically is cost. If we were to consider the same number of shares or total dilution which is equivalent 10,000 ESOPs and 10,000 RSUs, current share price being $10 for ESOPs and $10, of course, for RSU as well. From a cost perspective, the accounting hit that needs to be taken would be far lesser for an ESOP than it would be for a full value instrument. And the reason for that primarily is that with ESOPs, there is an uncertainty. So that is built in the fair value consideration. And the typical method that is used for that is either a Black-Scholes or a Monte Carlo simulation. And the typical range is the fair value is about between 30 to 40% of the underlying share price in an appreciation instrument like ESOP. Whereas in an RSU, the fair value is quite close to the value of the asset on that particular day, the $10 in this particular example. So in this example, the ESOP is valued at, even though the share price is $10 on the date of the grant, the fair value which is taken for any cost booking is 40% of that. Of course, 40% is just an estimate that I'm providing. An actual simulation needs to be done using Black-Scholes or Monte Carlo, but it will be in the range of 40%. So it's less costlier than an RSU. So from a similar dilution perspective, a full value instrument like an RSU would result in a higher cost than an appreciation linked instrument like an ESOP. So these are the trade-offs that need to be considered, aspects of dilution, value, cost, as we design a long-term incentive program and choose the instrument that we want to use. In summary, all of these, of course, are equity settled instruments. An ESOP typical strike price is the grant date FMV, fair market value. An RSU has almost a zero, and so it's a deep discount on the strike price. A share could be delivered at a zero value. From an awardee's value perspective, an ESOP is appreciation linked because the individual receives value only if there is an increase in price of the share between the grant date to the vest date, whereas an RSU or a share deliver almost full value to the rewardee because of the nature of that design. And from a dilution perspective, for a similar value delivered, an ESOP is a high dilution, whereas an RSU or a share is a low dilution. From a P&L perspective, for a similar dilution, low cost on stock option or appreciation linked instrument, whereas high cost on RSU or a full value instrument. Now, from a vesting perspective, vesting, of course, is the time from the grant date at which the award is truly considered earned by the individual. There are different vesting schedules that are prevalent. If retention is a major consideration, the vesting plan could look like a cliff vesting plan. A cliff vesting plan typically would have zero vesting in the initial years and then a cliff or 100% vesting at the final year. In this example, I've taken a 4-year vesting program. Of course, vesting periods could vary significantly. The most typical are between 3 to 5 years. Another approach to vesting could be a back-loaded vesting, where towards the end of the vesting period, there is a higher vesting proportion, whereas a small proportion of vesting is provided in the early years. In this example, 10% in year 1, an additional 15% in year 2, making it 25% cumulative in year 2, an additional 25% in year 3, making it cumulative 50%, and 50% additional in the year 4, making it a cumulative 100%. Now, a backloaded vesting continues to retain an overall retention objective because the large chunk of vesting is happening towards the end, but it does provide a bit of balance by some liquidity being offered in the early years as well. A more uniform approach, of course, could be the uniform graded approach where 25% in this particular example each year is provided to the individual in terms of vesting. If you do choose a LTI program which is linked to performance, say for example a performance share unit, then it also becomes important what performance measures you use, because what you need to keep in mind is that this is a long-term incentive program. So you need to use measures which can be measured consistently over that long-term period. You could definitely have operational metrics like revenue, profit, shareholder return metrics like share price, total shareholder return, TSR, or relative TSR are quite common in LTI programs which have performance linkage. You could also have subjective measures like aspects of transformation, sustain. What is important to consider is that the right mix of measures that need to be used so that a balanced perspective is provided on the performance that is expected and linked to the award of this LTI program. There are several governance considerations that are important as we build a LTI program because of the large amount of dilution, the cost, and several regulations that apply on LTI programs. So aspects of company law become significant, and as a result there should be a close collaboration between the human resources team, the legal and compliance team, the company secretary, while formulating the design of the LTI program. Taxation of equity awards, like I mentioned earlier, different jurisdictions do have different rules around taxation. Being aware of those jurisdiction specific taxation rules and applying it appropriately in any withholding regulations is of paramount importance. Since LTI is an important and a very large component of executive compensation, the board and the remuneration committee or the compensation committee of the board play a very vital role in the design of the LTI program, be it the pool, the mix of LTI instruments, and the measures that are used. So the board needs to be very closely involved in the design of a LTI program. Now we'll see a few questions that came up during the session and the answers to those. One of the questions was about, do you recommend ESOPs for early stage or startup organizations? The short answer is definitely LTI is a key part of the rewards portfolio, and I would definitely recommend it for any organization, especially for startups and early stage organizations, as they have a significant premium on cash and they would like to preserve cash for the future. Of course, the trade off would be the willingness of the shareholders or the founders to give away part of their ownership to fund such a program. But you could definitely be using an LTI program and be selective about who you use this vehicle for as you drive certain objectives in the organization. The question is around ESOPs being underwater, and in a situation like that, how can organizations manage retention? I'd first like to put the hat of an employee and actually state that employees and beneficiaries should look at stock awards with a larger time horizon, and a watched pot does not boil, and the same rule applies for equity linked awards as well. Short term fluctuations should not change your perspective about the future potential of the awards you have received as part of a LTI program. That said, uh, managing retention in a situation like this is definitely difficult, and organizations could approach in two different ways. One is by replacing an appreciation linked plan, that is an ESOP, with more of a full value instrument like an RSU. Another option could be to reprice and change the strike price or the grant price at which the option has been granted, with important consideration that requires to be done is related to aspects of tax that may apply in such a situation. Now, there are many organizations that may also decide not to do anything, because if the primary reason of granting awards is to link shareholder alignment with that of the employee, then the employee too must bear pain if the shareholder lost value, as is happened in this particular scenario. So there are organizations which may decide not to do anything in such a scenario, considering that shareholders too have lost a significant amount of their value by depreciation in the share price. What's the difference between an ESOP and an ESPP? These are two different concepts. ESOP, employee stock option, is a compensation component which we have delved in detail in the prior conversations. An ESPP is more of a benefit program. Here, employees get an option to purchase, and that to at a current date, as against at a future date in ESOP programs. They get an option to purchase company stock at a discounted value. Typically, the discount that I've seen is of the order of about 10 to 15%, and that discount is considered taxable as a perquisite. What's LTI as a portion of pay mix for executives? This could definitely vary significantly, both from region to region as well as from sector to sector, and also around the philosophy of the organization itself in terms of their total rewards construct. And benchmark reports will be available. That would be a better source to refer to identify the right comparators as you review pay mix. You could also look at some publicly available information for any public listed organizations, like proxy filing reports, where pay mix is available as a component, at least for the executive population. Now, that said, what I have seen is in the US, very high skew towards LTI, with LTI being anywhere between 5 to 10 times base compensation. A more equitable spread between components of base and STI and LTI is seen in the Europe pay mix data that I have seen. A question here: what does 500,000 mean if we make a statement that there is 500,000 worth of ESOP? Now, this is a very important question for reward professionals as you review any compensation data. Again, it depends on what information you're looking at or what the objective you're trying to drive. If you are reviewing a benchmark or a study report, then the amount that is referred to in the LTI column refers to the fair value on the date of grant. So for ESOPs, that value is derived using a Black-Scholes method. But if you are in a hiring situation and if you're trying to attract and retain a top talent, then the conversation could be around the potential value that you expect, especially if your organization is in a high growth trajectory. You could refer to the target price in the future and the difference between the target price versus the current strike price being the value delivered through ESOPs or any other LTI instrument. Question is around taxation rules. Are they the headquarter country rules or the resident country rules? I do want to add the caveat that I'm not a tax expert, and tax rules do vary from jurisdiction to jurisdiction, but broadly, the taxation rules that are applied are based on the resident status of the individual beneficiary. An important consideration for long-term incentive plans is global mobility. If the executive or the employee who is part of an LTI program is mobile and has moved from one country to the other, then a pro rata tax assessment and filing may need to be done in each of those jurisdictions that the employee was part of during the exercise period, that is between the grant date to the exercise date. A question on whether taxation rules apply on vesting or on payout. Of course, this is dependent on the instrument that is being used here as well. But the typical rule that is applied is that tax is assessed at the time of delivery of the asset. That's the reason why in ESOPs, taxation happens when the employee chooses to exercise, because that's the time when the option is converted to a share and a share is delivered to the individual. Similarly, in a phantom stock, it might be the payout of the amount in lieu of the award. So the time of delivery of the asset to the individual is what would govern taxation. The question here is cash bonus the same as SAR? No, it's not. And the difference essentially is that in a deferred cash scenario, there is a guaranteed amount that is promised to the individual to be paid at a future date as long as the individual remains with the organization. In a stock appreciation right, on the other hand, there is no guarantee on the amount. The amount that is payable to the individual is calculated based on the appreciation of the underlying asset, that is the share price. It's quite possible that there may be no payout as well if there was no appreciation in the underlying asset during that particular period. A question around the dilution constraint and how does a trust route help companies manage dilution? Now, this is an approach which I personally have not experienced or seen, but I'm aware of what the concept here is. In an organization where dilution is a major constraint, but there is no constraint on cash outflow, a company could set up a trust, loan cash to the trust. The trust in turn uses that money to procure shares from an open market, and by doing so, essentially there is no dilution from current shareholders. The shares are being procured, existing shares are being procured from the market, and these shares are then used to fund the equity program. And as the trust receives money from the beneficiary in the form of exercise cost in ESOP, for example, the trust pays back the money to the company. So cash outflow is definitely an important consideration, but dilution can be managed using this particular method. If the company is not sure of an IPO or an equity infusion, are there any exit measures for individuals who are part of LTI programs? There could be different approaches here. One approach could be a buyback. The company could buy back the equity shares that are provided to the individuals and provide some liquidity to the beneficiary. Another alternative could be to permit an internal market, which means employees in the organization could be permitted to buy and sell shares amongst themselves. The other alternative could be to replace an equity settled program with a cash settled program instead, if there is no visibility around a IPO or an equity infusion. With that, we come to the end of the session. Thank you very much. I hope you found this session enjoyable. I definitely enjoyed preparing for this session, and I would love to hear direct feedback from you as it pertains to this particular presentation. Thank you very much.